Let's take a look now at the historical 20-year data that has happened with bear market and bull market, the corrections, especially when it comes to looking at the S&P 500. We have 16 years of data on this graph. And back in 2008, everybody remembers how bad the market dropped. It went down 56%, which is huge. Now remember, when we talk about a bear market, it has to be at least 20%. So 20% or more is considered a bear market decline. Anything less than 20%, let's say a 10% decline, it's more of a correction. So we see these corrections in 2010, we see another correction in 2011, in 2012, 2013, 2014, 2015. So we can see that these are some minor corrections in the market between 10 and 20%. And we also have what's called these just small pullbacks, right? So they're not really corrections, they're just these small pullbacks of between 5 and 10%. So the major ones that we want to focus on is what happened when the market became very close to 20%. So we see that in 2022, the most recent event, the market now is at 20% or very close to it. But the amount of days that we are in this bear market is really what's important, because if you look back at when the market dropped 50%, it was about 517 days. So if we're continuing below 20% and we're now going into 150 days, we're going into 175 days, 200 days, this tells me that we are still continuing to go lower, as opposed to the most recent event where the market dropped 33% between 2019 and 2020. It only took 32 days and we were out of that recovery. So I want you to consider the amount of days that we are currently in this bear market and compare it to the previous long-term 517 days that the market was in bear market territory. It dropped about 56%. Let's take a look at a different chart. Here we have the prior 10 years, from 2000 to 2008, 2009, where we last left off. It only occurred twice where the market was 20% in bear market territory. So this is significant because now we have data that says that the longer that the market stays at that 20% plus in bear market territory, the further it drops. So 517 days in 2008, 2009, and 929 days, again about 50%, where the market was just continuing to drop and drop. What that means is that if we look at where we currently are, if we begin to continue to stay above 20% in bear market territory, and the days are accumulating under our belt where we see 200 days, 250 days, 300 days, the likelihood of the market continuing to drop is evident. This is based on the data that we have. Every time the market has dropped to these levels, the longer it stays above the 20%, the further it drops. And if the market quickly retraces, we can also see evidence of that as it tries to test 5,000 and even break 5,000. Based on the number of days, if we stay where we're at 20% bear market or more, 500, 600 days puts us at about the end of 2023, going into 2024. You should see the market at that point recover, let it hit the 2,500 level, and then start to make a huge rally to the upside. Hopefully it doesn't take that long, and hopefully we're not going to have that much pain going into this, but that is based historically on what it's done, the number of days, how long it takes, how far it drops. The time element is essential when thinking about where we're going to be at the end of 2023. Now, if you have any questions, if you'd like to join the new accelerated mentorship class, we include all the courses, all the software with lifetime licenses at a reduced rate. Visit DayTradeToWin.com. You can get a free member account. You can download some goodies, get started. Email us. We can set you up at no cost. My name is John Paul, and I'll see you at the next video. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and we work exclusively with new and beginner traders who want to learn more on how to prosper from trading.